Donald Trump there speaking to voters at a town hall in Rochester, New Hampshire, everyone, just moments ago. We heard a lot about the wall, of course, with Mexico. We heard a lot about how he wants to take care of veterans, how he wants to protect Social Security, and how he is going to be basically a god when it comes to creating jobs. You know, one of the reasons he has succeeded so much in this Republican primary thus far is because the economy is in bad shape. I mean, we got more evidence, of course, of that today when Janet Yellen and company refused to move on interest rates. We have been at 0% for 6+ years. What does that tell us about the state we're in and where the world is, and what does it all mean for the presidential landscape? Here to weigh in, Steve Forbes, Jay Pelosky, and Reva Shakkottai. Steve, I'm going to start with you here because you've actually been up on those stages before. You ran for president of the United States. How important is the economy in this election right now? Is that ultimately going to be the decider?
It is the big issue. And even in the debate last night where you had some more substantive discussions, still the economy is not forefront the way it should be. And the proposals they have on the table didn't really get delved into. So the economy is critical. We now learn that in 2014, median incomes in America fell once again. This in the 6th and 7th year of a recovery. So the economy is punk, and the question is, what do we do about it? And by the way, the Fed is part of the problem.
Well, let's talk about what the Fed did today, which was, once again, nothing. I've been warning of this. You've heard me, Jay. I'm like, they're not going to do a darn thing. We get all worked up and excited about it, and there you go. They don't move at all. And they probably aren't going to move in December either. And why is that?
Or October.
Or October.
Right, because they do have October as well as December to do this year. And I think what we learned today, the surprise today, is that we learned the Fed is unlikely to move for the entire rest of the year. Okay, not just today, but for October and December. And there are two reasons. First, the external conditions are very weak, as we've learned. China, emerging markets, Europe, Japan, no one really growing very well. Mm-hmm. And secondly, internally, financial conditions have tightened. So the market has done some of this for the Fed already. So if you look at the 2-year rate, for example, the short end of the interest rate curve, you've seen rates almost double in the last 3 months. So financial conditions, whether it's credit, whether it's leverage, no matter what it is, conditions are tighter. So in a way, the Fed's work has already been done for it by the market.
Steve, let me ask you the political implication of this when it comes to our debt situation. We heard, of course, Donald Trump talking about how we can't owe all these countries so much money. Does it make it easier for politicians to just keep borrowing to pay for all kinds of stimulus programs when money is as cheap as the Fed has made it?
Yes, the government, in effect, borrows without tears, especially when the Federal Reserve returns most of the interest it gets on its long-term bonds from the government right back to the government, just like having an interest-free mortgage. It also helps big businesses. But for small and medium businesses and small businesses and startups, this is a bad time. Japan's been doing this for 25 years. Punk.
See where it's got them.
And their debt proportionally is double ours, and they still have a bad economy.
Reva, what's the way out of this? I mean, what is going to grow our economy, in terms of when you look on the horizon, what is that growth industry that's going to take us somewhere? Is there one?
Well, I think that the Fed needs to move. I mean, that's part of the issue, that they're being hijacked by the markets, and it's like the tail wagging the dog right now. And if the Fed were to make a move, I think that's going to show a lot of confidence in our economy. In fact, if the Fed leaped 1%, I think that would show that we're on much stronger footing, and that could lead us to down 19,000.
You know, Reva's making a very good point here. She's sort of talking about the psychology of all of this. I mean, you got a Fed that basically is just out there reinforcing the lousy situation we're in. If they were to say, okay, we think things are okay enough that we can move a little bit. I mean, they didn't even have to do a quarter point. They could have done like 10, 15 basis points, right? Something. Would that have sent a more positive message, Jay?
Well, look, I think the issue is that the Fed is on hold. And the most important thing, I believe, in terms of the politics and the whole electoral cycle is its timing. What it means is that we are in a box, fiscally speaking, for the next 2 years. There's not going to be any fiscal action out of the United States to stimulate our economy, should we need to do so, until late 2017, early 2018. So at a time when monetary policy, I by the way, completely disagree with our guest who just spoke. Well, because I think if the Fed raised rates 75 basis points, the stock market would collapse, housing would go down.
Steve Forbes says no way, shaking his head.
Well, that's what makes a market, obviously. But look, I'll tell you what my big fear is today, as a guy who is an investor and who advises people on their investments, is that the Fed stayed on hold and stocks closed down. That was the big fear coming in. I hope it's partly just buy the rumor, sell the news, because the market's up 6-7% off its low of a month ago. But if, in fact, in the next couple of days, stocks continue to weaken, I think it will send a signal that the market is afraid that policymakers are out of bullets. There's no adults.
Well, but you know what? What about QE? Could they do another round of QE? Reva, what do you think about QE? Another go at that. Print some more money and hope for the best.
No, QE isn't the answer. Since the global financial crisis of 2008, 14 countries have tried to raise rates, and 14 countries have backtracked. What we need to get the global economy out of this is policy leadership from the United States. We are the strongest, most diverse, dynamic economy in the world, and where we go, others follow.
So part of the reason we are in the situation we're in, Steve Forbes, is that we have had no leadership in Washington. We have had no real economic policies coming out of Washington, such as lower corporate taxes or some other kind of benefit to our economy. So the Fed's been the only game in town.
Well, the Fed may be the only game in town, but it's been a destructive one. No one asked the question why, after 7 years of zero interest rates, we still have this punk economy. And why do we have small businesses still have a hard time getting credit, a skewed credit market? What the Fed has done is like bleeding an anemic patient. It is part of the problem, not the solution.